Hello, everyone. Welcome to this edition of the Seven Market Movers. My name is Gary Quinzel, Vice President of Portfolio Consulting at Wealth Enhancement. Today, I'm going to focus on just two of the market movers, one being fiscal policy, most notably tariffs, which have been top of mind lately for everyone, as well as investor sentiment, which took a notable positive spin on Wednesday as we had the biggest up day in the market since March of 2020. The day started a little back and forth, but the first positive development occurred when we had a better than expected Treasury auction. Essentially, what that meant is that a lot of buyers showed up to buy 10-year treasuries, which was the opposite of what had just happened with the 3-year treasury auction the day previous. Basically suggested that there's no buyer strike yet. And it calmed some nerves in the market. So that was certainly a positive development. But more importantly, around 1 p.m. Eastern, President Trump announced that roughly 75 countries that had not retaliated against the U.S. with their own tariffs, but yet had come to the negotiating table or indicated that they were willing to do so, would receive a 90-day pause on the reciprocal tariff rate previously announced, and instead would only get the 10% baseline tariff. And so the market very positively received that news. The one notable exception to that policy, of course, is China. China has retaliated, and of course, there's been some back and forth there. The latest tariff on China has been lifted to 125%. And China's tariff on the U.S. up to 84%. And unfortunately, it appears that this could continue on for some time. So certainly more to come on that story. But the good news for the market was, as I mentioned, we had the strongest up day in quite some time. I mentioned the S&P 500 having its best day. It rose around 9.5%, up over 5,400. The Dow Jones Industrial Average climbed 2,900 points, just a huge number, up around 7.8%. We saw the NASDAQ go up around 12%, driven by a lot of those big Mag 7 names, of course. They're in the S&P 500 as well, but things like Apple and NVIDIA, Microsoft, Amazon, Meta, et cetera. All those big tech stocks had very big days. And so it was definitely a risk-on rally. We saw a big price appreciation in things like gold, up around 3%, biggest day since 2023. We saw oil bounce off its 4-year low, up around 4.7%. And even some assets like cryptocurrencies like Bitcoin also had strong days. On the yield, on the fixed income side of things, I mentioned the better than expected Treasury auction. Yields had been falling, bonds had been rallying at the start of this kind of equity sell-off. But the last couple of days, we did see a bond yield back up. In fact, we saw the 10-year yield go higher than 4.5% overnight, prior to falling back down to around 4.34% the day of the auction. And so one reason that we're actually seeing some leveling off of some of the yield moves is that we're seeing some of the unwinding of some of those basis trades that Doug Huber, my colleague, mentioned the other day. That is the highly levered arbitraging of the difference between the cash and the futures price of Treasury securities. And so some of these highly levered market movers have definitely been exacerbating the market moves that we've been experiencing, certainly causing a lot of more fear and more uncertainty when we see these giant swings in equity and in fixed income. And unfortunately, some of these moves are likely going to continue as the uncertainty prevails. And so we are certainly not out of the woods yet. We are certainly slightly more optimistic when we hear the news, such as what Treasury Secretary Scott Bessent mentioned, that he believes many countries are going to come to the table and start negotiating. But we still have to wonder what's going to happen with one of our biggest trading partners, China. One example came out the other day about the potential cost of iPhones, as reported by a Bank of America analyst. The cost could go up as much as 90%. Per that analyst, if they were produced here in the U.S. Now, obviously, that's just one product, one example, but it's pretty symbolic of what the typical U.S. consumer could experience if those tariffs were actually implemented on a more permanent basis. So certainly much more to come on that regard. But for one day at least, it was certainly welcome to get some positive news. And as always, we just highly encourage our clients to stay calm out there as best you can. Don't let your emotions drive your financial decisions. As we always talk about, missing just a few big up days in the market can have a very detrimental long-term impact on your overall long-term market performance. So staying invested is typically the best course of action. Stay disciplined, stay diversified. And if you have any questions, please reach out to your financial advisor. That's all for today. Stay tuned for future updates. Thank you all and have a great day. Take care.